Hello and welcome to my next War and Markets review. This is for Friday, the 8th of May. Recording this late in the night, so probably post it up early morning on the 9th. The market's performance today was in line with the way it's been behaving for the past few days, which is notably that strong FI selling, strong FI short books, but significant amount of domestic buying across the board in terms of both mid caps, small caps, and micro caps. However, it was not such a sharp divergence today. The Nifty was down about 0.6%. The mid cap, small cap, and the micro cap indices were all very marginally positive or negative. The advanced decline ratio was at about 1280 stocks advancing with 1600 odd stocks declining. So clearly a tilt toward the bearish side. The causes for the same are, of course, the continuing hormones related uncertainty with some firing actually occurring today. But Mr. Trump then eased the pressure by saying that this is just a love tap. But the fact remains that oil remains at around 100 and the rupee also today weakened a little bit. So the situation is that uh, till the clarity emerges there, FIs are going to continue to be next sellers. They sold about 4,000 odd crores today, and hence the large cap pressure comes from there. And as has been the pattern over the last few days, which I pointed out yesterday, is that whenever the FIs step up their selling, the DIs step up their buying. The reason being that when FIs are selling, those prices will come down and DIs feel that they get these good quality stocks at a slightly cheap price. So that's the kind of, I would say, trying to be smart buyers there, which is, I think, overall good. The second thing which happens is that because of the geopolitics and the currency and the oil, the markets are in a very nervous state, even as far as domestic investors are concerned. So what they are doing is that they are seeking any good news to accumulate a sector based on a stocks news and sell a sector again based on a stock news. So they are very reactive. So you can create a very jumpy market, I would say, in that sense, right? So, for example, today what stood out, for example, was SBI's results was much below expectations because there was pressure on the net interest margins, right? So, because of which, obviously, the SBI stock got hammered, but it took down the whole PSU bank index, and a lot of leading private sector banks like HDFC and all also faced the pressure. So, this is a very typical behavior of that. Similarly, on the consumption side, Titan reported pretty good results, and you saw that it took the consumption back up. So very, very nervous market, and that's one of the reasons that I've been telling you all that do not do sector picking at this point. Leave it to the smarter players backed by expertise like the fund managers, whether of mutual funds or of portfolio managers, to take these calls. Because what was a good sector yesterday is a bad sector today. You can clearly see that today the tilt was towards more of a safety. So IT had a good run today. We also had pharma and the healthcare piece doing well and consumption doing well, whereas the PSU banks obviously was the worst performing, but generally the rate sensitives were on the back foot today. So clearly this holds out the pattern that I've been recommending, that you keep using these opportunities to keep buying small amounts. I think nothing actually changes. You don't need to change any strategy and keep sticking there. Somebody requested that since I've been talking more about medium-term investors, well, I should also talk a bit about long-term investors. So long-term investments, I would say, is that the best route is to follow an asset allocation pattern, regardless of what comes in the middle, right? So the war and all, in fact, represents good accumulation opportunities, but you got to have the discipline to stick to your goal planning driven asset allocation, which will vary depending on how close you are to your goal, how old you, and what is your risk appetite. So I would say that actually for long-term investors, such conditions that prevail are actually a good time to keep investing. But like I said, it's not about timing the market, but just staying in the market, right? So even if you don't want to commit extra cash, even if you stick with your portfolio, it'll hold you out in the long run. So now I'm not going to talk too much about the next day's market because it's 2 days away. And as you know, in these days of Trump's tweets and tantrums, 48 hours is a very, very long period. One, of course, always signs off with the hope that there is a resolution on the war front so that FIIs can then stop discounting India purely because of the oil related impact, right? Which is one of the many factors that FIs are looking at, but at least one will go away. So we keep hoping and praying for the war to end, but that should not delay your accumulation decision of your diversified portfolio in staggered quantities, right? Thank you, and I'll meet you with my weekly update on either Sunday night or Monday morning, where hopefully we'll have some clarity about what to look forward in the next week. And as we are now progressing in the earnings season, I think from next week onwards, probably I will try and cover some amount of sectoral earnings, but it's still too early in my view to take a sector call based on just a few companies reporting. Okay, so look forward to my next weekly review update to catch up with you all. Thank you and goodbye.